Hello everyone and welcome to Chapter 9. But before we get into Chapter 9, I've got a couple of comp in the news related to COVID-19. Now the first one has to do with pay equity, which is something we've talked about already. So this disparity in pay between genders really seems to have come to the surface because it has affected women more than men in this particular instance, because as you can see from these statistics, 70% of restaurant workers, 77% of clothing retail workers, 70% of workers in the health and social care sector are women. And those obviously have been very affected by this virus. So this may become even more of a current topic and an issue as we move forward. The next one has to do with unionization. So as you know, again, when in terms of unionization, those numbers have actually gone down. But because employees right now are really feeling a lot of stress because they are worried about their jobs, but they're also worried about getting sick. And so here it shows Whole Foods employees had staged a sick out because they were demanding hazard pay. What they were doing, just going to work at this grocery store, is very hazardous, and they were worried about the conditions there. Nurses, flight attendants, auto workers are also looking at organizing. And today, with the technology that we have around social media, the ways that people can connect is just different. So it'll be interesting to see if these conditions will create an increase in unionization as as employees may look to organize, or if it just kind of dies down once the situation passes. All right, so now we're going to get into Chapter 9, which is discretionary benefits. So discretionary benefits are those benefits which are not what? That's right, required. So the next chapter we're going to talk about is legally required benefits. So discretionary means voluntary, means it's not legally required. So as with all things, if this is voluntary, if they're not required, organizations need to be strategic in how they're going to go about choosing these different benefits. So what is that total reward strategy? What are other companies doing? Do we know who our employees are? Are they in a lot of different generations? Do they have different needs? Are they unionized? Of course, we also need to consider any of the tax incentives or the costs. Budgets, as we know, are very, very important. And then just how we're going to communicate this so that, employees will see the value in what we are providing. Okay, so we tend to want to do this to attract and retain. This is the big thing. So if we go back to, I think it was Chapter 1 that I grabbed this. So what are the three broad categories of discretionary benefits? So over on the right-hand side, those non-monetary compensation. So the first category is paid time off. The second category, which includes insurance and security plans, are protection plans. And then the last one is services. So what are welfare practices and what brought them about? So the welfare practices are really just anything that an employer can provide that helps their employees in terms of the comfort and improvement, intellectual or social. What brought this about was in the 1940s. Some things were going on, right? Great Depression, other things, but there was a wage freeze. The government had a major wage freeze, and because of that, they couldn't increase or decrease wages. So instead, what employers came up with was offering these types of benefits, primarily health insurance at the time, which wasn't legally required. And this is something that was good. It helped to promote good management, but it also helped to improve worker productivity, because if you're taking better care of your workers, then they're able to work and be more productive. Now, you can't possibly see what this URL is, and it's extraordinarily long, but there's an article by Sherm that talks about how these discretionary benefits really are now essential, again, to attract and retain. And so they are no longer optional, and organizations really need to consider, again, who their demographics are, how they're going to use these strategically in that total rewards package. And as we'll talk about in a little bit, some of the benefits that have really surged in the last couple of years are the student loan, health, and financial planning. All right, so we're going to start with our protection programs. So the protection programs start with disability insurance. And disability insurance is that insurance that you get when you become disabled, right? So it replaces your income when you become hurt or ill, okay? So short-term and long-term. So short-term is less than 6 months. And it is when you have the inability to perform any and every duty of a particular occupation. So it has to really do more with your job. You can't do your job anymore. Okay, whereas long-term disability provides those benefits for periods from 6 months to perhaps the rest of your life. And because of that, it might start off kind of that short 6 month period where you can't do your job or your occupation, but it branches out to you are so injured, your disability is such that you are not even able to engage in any occupation for which you are qualified. Okay? So under the umbrella of disability, okay, here you have many these insurers talk about pre-existing conditions, and this is legal for disability insurance. When we talk next week about the legally required benefits and health insurance under the Affordable Care Act, pre-existing conditions, okay, have gone away. But this is disability insurance, and this is still legal to have this kind of a pre-existing condition clause, which just means that if you have sought care or advice or anything from a healthcare professional for a mental or a physical condition prior to getting this insurance, that is a pre-existing condition. Okay, so and then pre-eligibility period. Generally speaking, when you go to work for a company, they're going to say you've got like maybe a 3-month period of time before you are eligible for various types of benefits, and disability insurance is one of those. So it's from the time you got hired till you are eligible to have this insurance. Elimination period is just that minimum amount of time that you have to wait from the injury or illness that causes you to be disabled, okay, until you can start collecting on this health insurance. So for short-term disability insurance, that's probably just a few days, right? So you've fallen, you've broken your leg, something happened, you can't perform your job, and so that short-term disability will kick in fairly quickly. What else we got? Exclusion. Exclusion provisions are those health conditions or injuries or illnesses or some disability that is a result of something that is excluded from you being eligible for this insurance. And generally this is like a self-inflicted injury. So if you have hurt yourself, you cannot collect on the insurance. All right, so still under the protection programs is life insurance. So all this is life insurance. And our book talks about 3 different kinds. We have term, whole life, and universal life. So term insurance is for a term. It's for a term of time, a limited period of time. Usually it's like 20 years, which sounds like a lot. But if you're 30 years old and you get a term life insurance, then it expires when you're 50. Okay, and whatever premiums you paid in will go away. So it's for a very specified period of time. But your premiums are fairly low, okay, and they're guaranteed to stay the same over the term of the insurance policy. You also, if you do die in that term, those death benefits are guaranteed. But whatever you pay in, it's part of the insurance, and you're never going to get that back. Okay, so that's your term insurance. Whole life and universal life are both what they call permanent life insurance plans. They're not a term, it's permanent life insurance plan. Okay, so let's talk with whole life. Whole life is for your entire life. So whenever you start that insurance and you continue to pay your premiums, then it is until you die, right? And that and your premium is fairly high, but it's guaranteed. You know exactly how much you're going to be paying every year in that premium. Death benefit is also guaranteed whenever you die. That guarantee, that death penalty, I'm sorry, the death benefit is there. There's a cash value component, meaning the whole life is your insurance, but then it's also like an investment vehicle. So part of your premium goes into a high interest rate savings account. Okay, and so there's money available for you. You could actually take a loan out against that. You can, you know, when if you were to end this insurance, you'd actually get some money back. And so it can be an investment type of a vehicle. Now, universal life is very, very flexible. And so, again, it is for your life, but the premiums vary between a minimum and a maximum. There is a minimum amount that you have to pay, but it's decided by you how much you want to pay in. And anything that you pay above the insurance amount goes into kind of a savings account that is invested. And so the cash value of your those premiums are in addition to the insurance will also vary. But again, the death benefit is guaranteed. Okay, so there's a lot of interesting ways to use life insurance as just strictly life insurance or also as an investment vehicle.